Is Kaynestechnology a high-flying growth engine or just hitting a major speed bump? Today we are doing a deep dive into their Q3 FY26 numbers to see if this electronics giant is still on track. The headline is a classic tug-of-war between a record-breaking order book and a significant execution miss. Our Q3 FY26 snapshot shows mixed signals. While the order book is exploding, up 50% year over year, we saw a significant revenue miss. Revenue came in at 804 crore rupees against a guidance of 1,300 crores. This forced a guidance cut for the full year, lowering the target from 4,400 crore to 4,100 crore rupees. Let's look at that top-line gap. There's a staggering 38% miss between projected guidance and what was actually delivered. While year-over-year growth is still up 22%, the quarter-on-quarter trend shows an 11.3% decline due to execution delays and component pricing issues. Despite the top-line miss, margins are holding up under pressure. The EBITDA margin is stable year-over-year at 14.5%, actually up 30 basis points. EBITDA grew 24% to 116.8 crores, while PAT rose 15% to 76.6 crores, even with sequential pressure from Chinese component discounts. The big bull case here is revenue visibility. Kaynes has a record order book of over 9,072 crore rupees, a 50% surge year over year. This acts as a safety net with demand contractually locked in for the next 3 to 4 years, meaning the orders remain even if execution is currently slow. Where is the money coming from? As of the first 9 months of FY26, 55% of revenue comes from industrial and EV sectors, followed by 28% in automotive. Crucially, they are moving up the value chain with box-build high-value integration now making up 43% of the business. The balance sheet foundation remains strong. Kaynes maintains a very low debt-to-equity ratio of 0.1. With a net worth of over 4,600 crores and a net debt of 665 crores, they have a strong cushion from their IPO and QIP to navigate these execution issues. However, there is a critical cash flow alert. Cash is getting trapped in sales. Receivable days have spiked from 107 days last year to 139 days currently. This means sales are being recorded, but the cash isn't being collected fast enough, creating a gap between profit and actual operating cash flow. The next frontier for Kaynes is moving from assembly to manufacturing. Their vertical integration strategy includes the Sanand OSAT facility ramping up and the Chennai HDI PCB plant nearing operational readiness. They are positioned to benefit heavily from Make in India tailwinds. Is the stock priced for perfection? At 3,918 per share, the trailing PE is 70.4. which is rich compared to the industry average of 64. The market is pricing in aggressive future growth, which is why execution slips are being punished so heavily. The final verdict is a tale of two timelines. The good news includes the record order book, low leverage, and semiconductor entry. The bad news is the massive 38% guidance miss and spiking receivables. We are cautious in the near term on execution risk, but constructive long-term on structural demand. Kaynestechnology is at a crossroads. Does that record order book justify a 70 times PE ratio in your portfolio? Follow and subscribe ZinvestZ for more such smart investing insights. Thanks for watching.